Forgot to say this in the beginning, so I'm adding it now. Video episode of the Trading Coach Podcast. Watch on Spotify, watch on YouTube, or listen everywhere else. Okay, edit, now, go. So we've all heard of FOMO, right? Fear of missing out. Usually this shows up as traders are overtrading, jumping into setups because they're scared that the market will leave and profit without them. But let me ask you this. Have you ever heard of the phrase JOMO? Sounds kind of weird, but it stands for the joy of missing out. And in trading, that means actually getting pleasure from not taking trades. Now, this does sound safer, right? But in today's episode of the Trading Coach Podcast, I want to share with you why JOMO could be just as damaging as FOMO and how you can deal with it. So let's start with a reality check and just rip the Band-Aid right off, right? Every trader goes through rough patches. I don't care if you are brand new and still in your trading diaper or if you're a close to 20-year vet like myself. At some point, we all stink, right? That's just part of the game. The important part, however, and this is what separates the struggling from the successful traders, is how you deal with it. Now, before we jump into some of these solutions, let's break down the three main reasons, or I guess three types of rough patches that traders go through. And you've heard me talk about this before. These are called drawdowns, right? Periods where your system or strategy just isn't performing as expected, and they're due to various reasons. Now, if you're a new trader, again, this is going to be very important because drawdowns are what often cause what we call system hopping, meaning that you start trading something, the performance doesn't meet your expectations, so you blame the strategy or the system, you bail on it, and then you jump to something else. When you jump to something else, maybe you have short-lived profits, but eventually it hits a drawdown as well, then you ditch it and you jump to something else, and you kind of stay in this path of consistently like finding strategy, ditching strategy, jumping to the next one. Finding strategy, ditching strategy, jumping to the next one, and it doesn't really get you anywhere. It's kind of like running on a hamster wheel. You're doing a lot of work, but you end up exactly where you started. So the sooner you can make peace and accept that this is part of the equation, this is a completely normal part of trading, the better you are going to be with mentally dealing with it. So the first type of drawdown is this. Randomness, right? This is the one that no one likes to hear, but it's true, right? Trading is all about probabilities. Now, just like rolling a dice, in the big picture, right, longer term, our results should trend towards whatever our edge says we should expect. However, short term, you got me, right? Anything can happen, right? Sometimes that is just what the markets do. They are random from a short perspective. So there are random wins, there are random losses, there are random hot streaks, there are random cold streaks. It's part of the game. The second reason that these drawdowns or these stinky periods occur is just simply due to market conditions, right? Sometimes the market conditions just suck, or they suck compared to what you need them to do for your strategy to, be at its best. We've spoken about this in previous podcasts. I think the very last one we talked about sabotage, or 2 podcasts ago perhaps, right? But I talked about a trader who got destroyed in the month of September because the market just wasn't moving in a way that suited his strategy. For example, if you are a trend continuation trader, meaning that your strategy does the best when the market is moving in a natural flow of long extensions and small pullbacks and long extensions and small pullbacks, when the market conditions get sloppy and choppy, there are going to be some really tough times for you. And that's simply because the conditions aren't right for what your strategy needs. This is also normal, by the way, but it's also a very important reminder of why we do our back testing, right? Back testing specifically on different pairs or different assets will tell us about the personality of whatever we're testing. Gold, for example, historically trends. So if you're going to be a counter trend trader or adapt a style that works really, really good during periods of consolidation, gold may not be the best bet for you. For example, going back to the trend continuation example, Aussie Canada or Euro Pound, these are pairs that typically just kind of bounce back and forth between a range. You're going to get beat to shreds if you are a trend continuation trader. But if you've gone through the testing process correctly, you would know that. You would know what assets are best for your type of trading style and which ones to avoid. There will still be randomness in periods of both no matter what, but at least you're trading the one that works better the majority of the time in the way that you need it to work. more words. I just came back from a run, so I need some food, but I want to get this out before it left the mind. The third reason, this is the one that most of you are guilty of. It is, I'm pointing at the camera, didn't mention another video episode, but I'm pointing at you if you're listening on audio only. But you are the reason you are in a drawdown, right? So this is often the toughest pill to swallow, right? Sometimes we are the problem. Yes, you, me, I, all of us. Traders do dumb stuff, right? We do dumb stuff thinking that we're helping our results, but more often than not, we're actually sabotaging our edge. And if we kind of think about it, it makes perfect sense. If we've gone through all the correct steps of learning to trade, strategy development, back testing, forward testing, right? Demo trading. We have tested something in a hypothesis, a theory that we think should be profitable. We have tested, and that test has given us proof that yes, this thing is profitable. But all of a sudden, once we get past all those stages and enter the live trading stage, and we're hit with a little bit of adversity, we start doing something completely different, right? Where we have something that works that says, Akil, dear Akil, I will make you money. And then we don't follow it and do other stuff, right? Thinking that we're going to suddenly outsmart it when we didn't outsmart it in the last whatever 1,000 trades that we tested. It makes no sense, but this is the human element of being irrational, right? Human beings do dumb things for dumb reasons, and we think with this instead of this a lot. So now that we talked about the three ways or the three different conditions, I guess, that cause drawdowns, or the three culprits, whatever you want to call it, let's talk about some solutions. So reason one, right? Randomness. The solution is simple. Keep trading. Boom, we're done. The law of large numbers says this, right? It says that over enough trades, right, results will converge towards your expected outcome, right? Hot streaks will happen and then they will end. Cold streaks will happen and then they will end. And eventually you will kind of revert to the mean, or the mean of whatever your strategy's expectation is, your edge, your profit factor, right? The key, however, is we just need to stick with it. We need to trade through good times consistently. We need to trade through bad times consistently, and just reach whatever that larger number is at the end of the year so that we can maintain profitability. I've told you this time and time before. I've always looked into different seasonality when it comes to trading, meaning that, is there an edge for not trading during certain months or trading with more size during certain months? And in my trading experience, in year 19 now, and we'll take away a little bit of the beginning ones because I sucked, so the entire season of the year was bad. But what I've noticed is that, I've been consistently profitable for a very long time, but it's always come differently. And this is a good example this year as well, meaning that I've had periods where I got off to these amazing hot streaks and then I got cold for the rest of the year and was profitable. I've had years where I started off normal and then I kind of just stalled sideways and I got hot at the end of the year when I was profitable. I had a year where I start the year, the first 6 weeks or so, with a 17% drawdown, the biggest drawdown of the modern age of Akil. I say the modern age because it's the Akil AD, right? After dumb stuff, right? After that period, right? Because I was just losing whatever. I had a 17% drawdown to start the year. It was January 1. I was all hyped up to have a really good trading year and went right in the tank. But then I just slowly recovered and consistently, traded my plan throughout the year, and it ended up really, really, really good. So it's I've given up on saying that, hey, I always do good in January. I always do bad in the summer. I always do, good in December, right? I just accept the fact that I never know when the hot streaks or cold streaks are going to come. My job is just to trade consistently throughout the year so that when they do come, I take advantage of them, the hot streaks. And when the cold streak comes, I don't do anything dumb to make it more than what they are, right? Just a simple drawdown. So all that to say, just consistently trade the plan and make your adjustments at the correct times to make your adjustments. But that's another story for another podcast episode. So reason 3, right? We're going to skip, I didn't forget, we're going to skip 2 because we're going to come back to that later. That's the tricky one. But reason 3, you being the problem. This is a simple one too, right? Do your job, right? But the solution, if you find yourself in a drawdown and you are the culprit, meaning you're knowingly doing dumb stuff to make yourself worse and you can't figure out how to stop, The simple solution is to stop, right? You need to stop trading, right? If you are breaking your rules, if you are freelancing in the market with your strategy, you are no longer trading your edge. You are just throwing darts full of money at random candlesticks in the market, I guess. Yeah, bad analogy, right? Then you have to buy a new monitor because the darts will break your monitor, but you don't have any money to buy a new monitor because you've been on a losing streak, right? See? So don't do it. Anyway, again, while you feel like this may be helping, in reality, what you're doing is you're just introducing chaos to the equation, and it almost always ultimately ends in failure. There will be times where you do random stuff and it works for a little bit, but eventually, again, everything will even itself out and you will be broke. Now, let's go back to talk about number 2. This is the tricky one, right? Market conditions. And if you're skilled enough, if you have a lot of experience in the market, you may have the ability to recognize when conditions are in your favor. Now, this is very important if you are skilled enough, because something I hear a lot from traders that, not that I work with, but random traders on the internet, is that, hey, I tell them what I told them earlier. Hey, trend continuation opportunities are good when the market is trending, but bad in consolidation, and vice versa for other types of strategies. And they say, well, Akil, simple solution. I'm just going to be a trend trader when the market is trending. I'm just going to trade consolidation when the market is consolidating. And I'm just going to back and forth and make that money, baby. Right? It's been a long time since we did that. Bringing it back for Inside Joke for You Trading Coach podcast frequent viewers. By the way, if you're not a frequent viewer, hit that follow button so that you are. And that way, whenever I put out a new episode every Monday, Wednesday, and Friday, it comes directly to your feed and you know to check it out so you can become a better trader, right? Just follow wherever you're listening to this at, or subscribe if you're on YouTube. But the problem with that, the problem with saying I'm going to be a trend trader when the market is trending, I'm going to be a counter trend, and I'm going to stop it, I'm going to be a counter trend trader when the market is consolidating, is that we never know that the market is trending until it's already been trending. We never know that the market's in consolidation until it's already consolidating, right? You can use whatever indicator you want. There are people out there, well, I have this indicator that tells me when the market is going to trend. False, right? Indicators react to price action. So by the time your indicator indicates some type of trend in the market, it means that the market and price action, the chart, has already been trending. So not even that, right? There are ways to catch it early, but you're not going to be able to identify it before it happened and flip the switch. So it's a bad idea. With that being said, the experienced trader, they can look for the small clues. And although they may not be able to tell when the market is trending before it starts trending, they can tell when it's trending as soon as possible. And that will allow them to say, hey, okay, time to play with more size, or if it's vice versa when we're consolidation, hey, time to back off a little bit. Again, you're still going to take a few losses, but think about it like this. It's the difference between taking maybe 1 or 2 losses when the market is kind of shifting conditions versus taking 5 or 6 shifting conditions, and then you switch strategies, and then that next strategy takes 5 or 6 more losses, because by the time you got into your strategy B, market conditions are back to condition A, and you're just whipsawed back and forth. So yes, technically you can make the decision that, hey, I'm going to stop trading when the market conditions aren't in my favor. But here's the thing, it does come with a cost, an opportunity cost. That was supposed to be like the dramatic, like, zoom in moment where I do like the eyebrow thing, but I don't think I pulled it off, but I try, right? Working on my acting career here. Also, going back to the example I told you earlier about being late, we just had this conversation in the live room this morning. One of the problems with being late and, shifting out of a strategy after a losing streak only to go to another strategy, and then that strategy starts losing, and then you see that your original strategy would have won. This is a big emotional trigger. And one of the conversations we had this morning is about drawdowns in general, how drawdowns are natural, right? It's okay to lose. If your money management and risk management tactics are correct, they should be a drip in a pond. It shouldn't really bother you. But the problem that we get into as traders is when we turn natural drawdowns into self-inflicted drawdowns and we make them larger than life. Meaning that because you're angry that you missed out on an opportunity and you lost on both sides, now you let that anger take you into the FOMO, where you start getting, wanting revenge on the market. You start overtrading, you start trading with more size, and now you're still in that drawdown, but instead of being a normal one, it's increased because you're doing more dumb stuff. So those are the things that we ultimately want to avoid. But beyond that emotional side, which is very important, by the way, so don't just sweep it under the rug, but beyond that, a bigger issue that happens when you stop trading is that it really hurts your I guess you could say, your evaluation process. And one of the traders that I highly respect in this industry is Adam Grimes. I've mentioned his book a million times here. I did a whole podcast episode where I gave you different resources of him that you can follow. I'll link it in the description box below if you want to check it out. But one of the things that he says, and I wrote this down, he says that when you reduce your frequency during a slump, your results become less reliable because you're actually adding more randomness into the mix. And I have a great, and what that means is this, right? Our numbers are only important when we have a large enough sample size. So think about your back testing, for example. If you were to back test 10 trading opportunities, you can't properly judge that because, again, that can be a random hot streak. It could be a random cold streak. It could be random. If you had 10,000 trading opportunities, right, you're likely to get a much better picture of what to expect because there's going to be less randomness in that larger number. So by reducing your frequency, if you're in the process where you're evaluating, and you should always be actively evaluating your trading strategy, but you're actively evaluating your trading strategy and making whatever adjustments you need to make or planning to make future adjustments, by reducing that frequency, now these trading opportunities are more random than anything else. So this happened in my trading career once with, I was trading a few pairs that had really, really big ATR. So they were very volatile, and they were so volatile to the point that they were outside my risk level, meaning that in order to take the trade, I would have to risk more than I was comfortable with. So what I started doing was I didn't take the trades that were outside of my risk. And this was a normal thing. Usually it came every once in a while, but we were in a very specific market condition where ATRs were just crazy. And I remember that this was happening so often that when I would go and review, let's say there would be like 30 trading opportunities that I should have taken within that period, I only took maybe 10 of them, right? Because the other 20 were, outside of my risk. And when I'm evaluating myself, I'm looking at this and I'm saying, okay, well, I had 20 trading opportunities. Why does something seem weird about these results? Or 10 trading opportunities, excuse me. And why does something seem weird about these results? And pretty much, I couldn't really take the results. I had to take the results with a grain of salt because I didn't take into account the other 20 that I missed. And long story short, I'm doing a horrible job of explaining this, but pretty much what I was trading was random. I wasn't executing my edge, where I should have been trading all 30 if the risk made sense, and then judging my strategy's performance off of that. I only judged it off of a third of the opportunities, and it just wasn't a proper way to judge, right? Because who knows, right? Maybe the ones that I took happened to be all the losers, and the ones that I missed happened to be all the winners, or the ones that I took happened to be all the winners, and the ones that I missed happened to be all the losers, right? It was just completely random. There was no rhyme or reason as far as an edge for taking or not taking. So it just didn't give me the information that I needed to see, hey, is this strategy still working the way that it should be working? Is it working on this pair the way that it should be working? Do I need to add this? Do I need to tweak that? And that was it was going to be very hurtful as far as my trading development goes. So by cutting down your frequency, by just stop trading, you're losing that credibility, I guess, in your evaluation process. Something else that we shouldn't forget is the learning process as well. And this is especially true if you are a newer and a younger trader. Experience is the best teacher. I am awesome, you're welcome, but there is one person better than me. Experience, right? There's nothing that beats experience, and it's going to give you the most information possible and allow you to make the most adjustments, and it's just an amazing teacher. But think about it like this. Every trade that we take is pretty much a data point, quantitatively, but it's also an experience data point as well, both emotionally, psychologically, however you want to put it, right? In a way, it's like a mini experiment, right? By journaling and reviewing, which I keep telling you guys to do, what we're doing is we're building our foundation for future growth, right? We are conducting this experiment. We are gathering data and information, and that information is very helpful in how we use it for the trader that we're going to be down the road. So think about it. I'm a track coach and we're cross country season right now, so I'm fresh on the mind. Think about it like a distance runner putting in those base miles. If you want to be a good distance runner, an endurance athlete, marathons, 10Ks, stuff like that, you just can't hop out of bed and go for a run, right? I literally did that today. I haven't ran in I don't know how many weeks, and I went for a nice, easy, I think it was like a 2-miler, and it was slow as hell. But I was able to do it because I have established a base over the years where I can take a few weeks off and my body can still do stuff like that without getting hurt or being completely winded. But the thing is, if you want to run at a quality level as a distance runner, you can't just do it in a week, right? It takes a long time to train. I discovered this when I was training for my marathon. So in the earlier stages, as you're putting in that little 3-mile run, that 4-mile run, that 5K, that 10K, the stuff that doesn't really seem that much, it is important because you are establishing that base that is going to be crucial in the future, because you're not going to be able to consistently do that 8-mile long run if you never did that 2-mile run in the first place, right? Your body uses those as opportunities to adjust and adapt and grow and progress, and trading is the same way. So going back to the stopping of the trading, if you stop or limit those reps, you are limiting your opportunities to grow. You are slowing your development, and your learning curve is going to take longer to achieve versus if you were getting rep after rep after rep after rep after rep. So what's the solution? Well, I've got one for you, right? I wasn't going to take you through this whole podcast and not give you a solution, at least my opinion on a solution. And my solution is this, right? So you don't want to keep losing money if the markets are in bad conditions, but you also don't want to stall your long-term development by stopping your trading. So what is the compromise? I got one for you. The compromise is to trade smaller, right? You keep putting in the reps, you keep analyzing the charts, you keep taking the trades, you keep collecting the data, but you reduce the amount of size that you're dealing with. When I say size, meaning like your position size. So if you were someone who was normally risking 2% per trade, maybe risk 1%, maybe risk 0.5%. So you're still gaining all the pros of it, right? You experience, you learn. If the market conditions do turn around, you can make profit off of it. But also, on the other hand, if the markets do continue their nasty and naughty ways, yes, you're still taking those losses, but you're not losing as much as you would usually lose. Now, don't get this twisted. I'm not a fan of the martingale technique or the reverse martingale technique where the more you lose, the more you reduce, or the more you lose, the more you add to your position size. This is something completely different. And again, I think I have a podcast on that. I'll link that below if you're not familiar with what the martingale technique is. But I don't want to make you guys think that I'm saying use that as a risk management technique. But just reduce size in general is something that can be helpful, and you can kind of get the best of both worlds, or I guess experience both worlds. I don't know. Anyway, those are my thoughts on it. If you have any thoughts, do me a favor, share it with the Trading Coach Podcast community. Leave a comment below here on Spotify. Leave a comment below here on YouTube if you're on it, or if you're listening on a different app where you can't comment, just shoot me a DM on social media. I love hearing it, and it may turn into a future episode. So before you go, like, subscribe, follow, rate, review, do all the stuff that allows me to grow this podcast. And until next time, plan your trade, trade your plan. Take care.